Welcome to the AMI second quarter 2026 update. I'm Michael Caruso. I oversee marketing here at AMI. Joined with me today is the entire portfolio team, and we're going to walk you through the most recent quarter and share some updates with you. Right here on the screen, you can see some of the disclosures. Go ahead and take a minute or two to go over them, read them, make sure you're caught up there. We're going to start with a strategy snapshot, and I'm going to hand it over to our CIO, Chris Sessing, and he's going to give you a high-level overview of what to expect. We don't expect this call to go more than 30 minutes or so, just as a heads up. So, Chris, please take us away.
Hey, Michael. So, quick strategy snapshot for those of you that are unfamiliar with us. AMI's goal is to generate attractive risk-adjusted performance over multiple market cycles. We do employ a dark strategy looking for high-quality growing companies. We do have a focus on recurring revenue business models, and we define that as a company whose product or service has a lifespan of less than 2 years. So think about a product that is purchased, consumed, and needs to be repurchased within that 2-year time frame. Shorter is always better for us. Portfolios are concentrated, 35 positions, with about a 25% annual turnover, most of which being trims and adds as opposed to wholesale name swapping. And we do target a lower standard deviation and downside capture versus the universe. And you can see that here in the chart below. Our outperformance in the down periods since our inception back in '98, we've had pretty sizable outperformance in those rough periods. From a market outlook standpoint, we continue to believe equities are attractive in the long run. There are some near-term issues that we're a little bit cautious on. We think the stock market is expensive by historical standards, which could create an unfavorable 10-year outlook. Market is highly concentrated, high level of names driving the market these days, which also can create for challenging future appreciation. You've got margin use, leverage ETFs, zero-day options at near record. Private credit still an issue, kind of ebbs and flows, but certainly those issues are still out there. Iran war, certainly oil has come off its highs and is easier today, but they seems to be firing up again as we speak. So, still a factor, we think. And basically, we believe that in order to avoid some of these subpar future returns, it's important to mitigate downside risk. So that's what we do here. The balance growth with downside protection. We think it makes for an attractive option in these uncertain times. So just diving into a couple of these points here, looking at the multiples, high multiples can make for challenging future returns. Each one of these blue dots shows you the starting PE that you purchased the market and the subsequent 10 years that you got after that. So this goes back to 1954 and pretty much shows you that lower PEs generate higher returns, as you can see in the upper left corner. And as we move down to the right, things get less attractive. Those blue dots in the negative territory are the bubble years of 99 and 00. Certainly didn't do well for the next 10 years if you buy at those highs. But basically where we're at today equates to a forward CAGR of about 3 to 4%. So not particularly attractive, but again, if you limit the significant drawdowns, you have an opportunity to improve upon this outlook. Market concentration. The blue line is showing you the percent of top 10 names in the S&P 500. You can see that previous highs, the bubble of the tech bubble back in 2000 was certainly a spike. We saw another spike in 2021, which certainly didn't bode well for 2022. And then today we're much higher even, so up here on the upper right. So certainly cautious on that front. We think that a broadening of the market would certainly help things. There's a few red flags in the economy. So we think the K-shaped economy is a good descriptor. Consumers at the low end are stretched. Consumer confidence is currently at level that have been previously in recessions, with except for 2022, so just a couple of years ago was the only oddball period. But every other period when we've been this low, we've been right at the doorstep or in recession. So certainly something to pay attention to. It can swing around quite a bit based on things like energy prices, inflation, but it is, I would say, definitely a red flag. Energy prices certainly have retreated. That should make things easier. But with the fighting going on in Iran again today, oil's back up again. So things can turn there pretty quickly. Housing has been slowing. High prices, high mortgage rates equal unaffordability. And then employment under the surface has been somewhat weaker than the monthly jobs report would suggest. See a lot of revisions come in after the fact, which takes down a lot of these numbers. We're more recently seeing a high number of part-time employment versus declines in full-time employment. So a lot of numbers under the surface are on the more concerning side. And then, of course, AI creates a whole host of uncertainty around jobs, around spending, and things like that. Certainly, Andy will have some good comments on that here shortly, but certainly I'd chalk it up to a red flag. Looking at performance for Q2, pretty much in line with the market. Did about even with the Russell 1000 growth and a little bit better than the S&P 500. From an attribution standpoint, looking versus the 1000 growth, as I said, we're just about dead even there on a gross basis. Asset allocation, our underweight to tech and our overweight to staples and healthcare were drags. But we made up for that, more than made up for that with security selection, primarily landing in information technology. And again, Andy will share more details there. Versus the 500, similar story. Basically, security selection made up for a little bit of benefit here on the asset allocation size due to the differences in the indexes. But basically, the story from a sector level is pretty similar.
Great, thanks, Chris. Now I'd like to kind of walk us through the gross attribution for the recent quarter. Andy, let's start with you. Go ahead and share kind of your name and your sector that you thought were contributing to our performance.
Sure. I'm Andy Zanfotis. I cover technology here at AMI. As Chris mentioned, AI has been the pretty much the main driver of tech returns. And from a very high level, after a bit of a pullback in Q1, within tech in Q2, we saw the AI trade get revived again. Investors essentially digested the Q1 earnings reports that took place in April and May, and learned that the big hyperscalers are still spending and seeing very strong demand from their end customers. And it's driven huge growth at all the cloud companies like Microsoft, Amazon, and Google. And that gave investors enough confidence in the AI names once again, which drove the stocks mostly higher. Now, along with that, we've seen market breadth narrow considerably. As Chris mentioned about market concentration, a little less than half of the S&P's market cap is now based on companies that are somewhat tied to the AI spend and growth from AI. And it's not just NVIDIA, which everyone talks about, and that was kind of like the first name out the door as the face of AI, but now it's including everything. Like now we have memory makers, CPUs, data center energy companies, networking, basically anything and everything that's tied to either AI or the build out of data centers. And everything else not involved in AI has been more or less kind of meandering. Now, from time to time, we do get these periods of digestion within the AI hardware trade specifically, much like we've been in the past week or so. As investors kind of take a step back and think about, wow, this is a lot of money being spent on data centers, hundreds of billions of dollars, and they start looking for return or higher revenues. And so now that we're coming up on Q2 earnings, which are due out in the next several weeks, we probably might need to wait for that once again to reignite confidence that all is well within AI, within tech broadly, and that all this capital is being put to good use. So elsewhere within tech, not just within AI, we still have issues in the software sector as that remains somewhat of an unknown in terms of what AI will do to those business models, and that's outside of cybersecurity, which has done pretty well and decoupled from the rest of the group. But for the most part, software stocks remain depressed, even though fundamentals have been pretty good, actually. It's just that all these massive earnings beats and all the excitement is happening in other areas. Hardware is just, pretty much sucking all the oxygen out of the room and taking all investor attention and money with it. Now, sometimes when we see hardware falls, software goes up, and it's become somewhat of a contrarian anti-AI trade to some extent. We don't think AI, the software trade, is over by any means, but for now, all the higher growth and excitement is in the AI enablers, and fortunately, we do own quite a few of these, which I'll touch on. First up, as you see in the table here, is Palo Alto Networks. As I mentioned, cybersecurity has been bucking the trend with respect to the broader software declines that we've seen, as AI essentially requires more comprehensive cybersecurity. With Anthropic, which makes the AI chatbot called Claude, which some of you may have heard of, came out with a version called Mythos. There was all this scare that it had all these cybersecurity risks and that it could find all these bugs and vulnerabilities within not just within enterprises, but within government networks. So there was this huge rush to get the cybersecurity companies involved, partnering with the AI model makers to make sure that we short up our systems and networks. And I think that drove a realization that most companies out there aren't going to just do away with what they have in terms of cybersecurity, like a company like Palo Alto. They need AI along with Palo Alto's expertise to defend against threats that AI will bring with it. And so it's becoming a much less discretionary than I think people have thought, and that you're going to have to spend on this on your cybersecurity networks. And so the company's fiscal Q3 earnings were very strong, accelerated organic bookings, as more and more customers are seeing the threats posed by AI and decided to buy more Palo Alto product. Next up is Taiwan Semi. And this company remains probably the single most important component in all this AI build out, as it manufactures, I'd say, almost all the chips that we talk about. Q1 earnings were reported, which came out. Our Q2 was reported about 40% growth year on year, record margins, guidance was really strong. The CEO said they can't keep up with demand, and again, Taiwan Semi is agnostic as to who ultimately wins in terms of chips, whether it's Google's chips or NVIDIA's chips or AMD's chips. Taiwan Semi is pretty much the linchpin behind all of it, and they're doing pretty well regardless of who ends up selling the most semiconductors. Next up is CrowdStrike, and this is very similar to the comments I made about Palo Alto. CrowdStrike is also in IT security, record new annual recurring revenue, which we call ARR. That was up over 30%, record cash flows. And again, similar to Palo Alto, differentiated itself from the broader software industry by saying, companies will need more IT security, more cybersecurity, and so that business is becoming much less cyclical than it had been historically, and we're seeing that in some of the numbers. Alphabet, formerly known as Google, doing very well. They have a very vertically integrated approach. So not only do they have search and all the products like YouTube that people know about, they have this massive cloud division, which did really well, as the people who want to use AI will turn to Google and say, let us rent out your servers so that we can deploy AI within our organizations. So that's doing really well. Google also has its own model, so they're lucky that they can deploy Gemini without having to pay sort of OpenAI for ChatGPT or Anthropic for Claude. They can just serve their customers using their own models at a much lower cost, and that's really good business for Google and their cloud division, because of this integration, having basically soup to nuts the entire AI available to you, doubled to over 460 billion. Last on the table is ARM Holdings, which is a relatively new position for us. So historically, ARM has been a company that had this architecture that is that's in almost every single semiconductor out there. So they can do high performance at very low sort of energy usage, so low heat, low power, which has been great for things like smartphones, right? Because you don't want your phone battery to go dead. So all the people who make semiconductors that are used in phones will base it on ARM architecture. And so ARM gets a royalty fee every time someone puts a new chip in a phone. Now, this technology is increasingly being used in data centers, but what really got the stock going in the quarter was they unveiled their first production chip that they're going to make themselves, which they're calling the ARM AGI CPU. And that's just a fancy way of saying they have their own chip now that basically can kind of run everything that an NVIDIA chip can do alongside it. So for every chip that NVIDIA sells, ARM's going to sell a bunch of their chips to be put on the same server, and that's going to be a big business. So if you think AI is going to grow and NVIDIA will grow, ARM as sort of a complementary piece should grow with it. As you know, as we move from AI sort of training into what we call inference, where it's actually doing real work, the type of chips that ARM is now making should start to do much better, and they'll sell more. And before I pass it back on to Michael, I'll touch on Netflix, which is also one of my companies, more on the media side of things and communication services. Um, so that stock, fell in the quarter. It was not so much due to deteriorating results, but really more what I call sort of ancillary events. So, their Q2 revenues were in line. They did announce their co-founder and board member Reed Hastings was going to step down and not stand for re-election. That caused a little bit of concern, perhaps. Management also chose not to raise their full year guidance despite having strong revenue and earnings during the quarter. I think that caught some people by surprise. I think the company was perhaps just being conservative. But also, there's been a lot of M&A drama. So they were involved in the very well publicized bidding war for Warner Brothers Discovery, which Paramount ended up being the victor. Netflix, actually probably did better in terms of stock performance once they lost that bidding. But they keep coming up in M&A conversations, and I think that has some investors potentially spooked as to what's going on there. And I think Netflix, we still like the company. They're still buying back a lot of stock now that they're not pursuing this very large M&A transaction. Free cash flows are strong. They still have compelling content. The company is still looking for ways to revive engagement, whether it's through live sports or other programming, but also expand the library in a very cost-effective way. And it's something that I think will take a little bit more time. But the company still has, in my view, a lot of levers to pull, whether it's on pricing, more geographies, more content they can produce, potentially at a lower cost with the benefit of AI. So those are things we'll continue to watch, and so we remain pretty bullish on the stock for now.
Thanks, Andy. Yeah, definitely plenty of stuff going on within your sector and your companies, especially last quarter. Andre, I'd like for you to share kind of what's going on in your world. If you could share with us, what sectors you cover and what happened within your sectors this recent quarter.
Sure, Michael, thank you. So I cover energy, industrials, and materials here at AMI, but energy was really at the center of this quarter. In Q1, energy rallied following that onset of the conflict in Iran, and in Q2, we saw a reversal of that with oil prices giving back much of that gain and returning to that pre-war price despite the energy storages units reaching concerning levels all around the world after a series of withdrawals to deal with the supply shock that we were facing. We are now 2 weeks into the Q3. That memorandum of understanding that we signed with Iran looks to say at least partially compromised, so certainly a very volatile dynamic here. So some important energy infrastructure that have also been, taken offline, not only in the Middle East, but also in Russia as a result of their conflict with Ukraine. So energy is likely to remain volatile in the near term and continue to weigh on inflation and the economy overall. And I just want to touch briefly on industrials, and the AI theme continues to fuel the growth of hardware and construction companies, those building the electrical, the communication fiber, the cooling, and the all of the infrastructure related to data centers. We have a company, Quanta Services, which didn't quite make to the top five, but performed really well this quarter as well.
Thanks, Andre. Rich, if you don't mind, can you share a little bit about what's happening in your world? I know you have a couple companies here, but give the audience a refresher on what sectors you cover and what happened in your space.
Sure. So I cover consumer, both staples and consumer discretionary. I would say the overarching theme has been continued concerns about affordability. Gas prices have obviously come down as oil has come down, but you're talking about a consumer that was already feeling pinched, only to have the cost of filling up their tank spike due to the war. Spending has remained okay. Some of that was tax refunds that were larger than normal, but very much a K-shaped economy where the low end consumer is kind of out, and so businesses that where that's a larger portion of their base struggled. More premium products obviously did better as that consumer has more money to spend. With respect to companies, so a couple bottom performers. So Ulta reported, Ulta, the beauty retailer, it was a very solid quarter. Comps came in ahead of expectations, earnings as well. But the guidance suggests slowing, getting out into Q2 and into the balance of the year. We view it more as prudence than anything else. Ulta is facing very difficult comparables from last year when their business really accelerated during the summer. We continue to like beauty as a segment overall. We view it as pretty defensive in this type of environment. We also like the focus of Ulta's relatively new management team on both growing comps, but also growing margins. The company had sort of fallen into spending to grow comps. We like the idea that they're going to be able to sort of walk and chew gum moving forward. Chewy was the other name, the online pet retailer. This is really a story of pet being under significant pressure. The cost to have a pet, especially a large dog, has really spiked in the post-COVID period, along with the sort of broader inflation. Pet household formation is just not where it once was, and people are continuing to feel pinched. They're cutting back on sort of the discretionary products that they would have otherwise bought for their dog or cat, things like treats, leashes, etc. The food business has held up relatively well for Chewy, but everything else is negative. That resulted in sort of disappointing growth and a guidance cut. We don't see that dynamic really changing anytime soon, and that's actually a position that we exited during the course of the quarter. I'll toss it back to you, Michael, with that.
Great, thanks, Rich. Chris, if you don't mind, go ahead and share maybe a high-level view of what you've seen over this quarter, as well as the sector that you cover.
Yeah, thank you. So I cover healthcare and financials. So I'll start with healthcare. From a high-level view, healthcare's been doing pretty well. I would say, kind of echoing what Andy said, where with AI sucking a lot of the oxygen out of the room, healthcare and staples is a similar dynamic. Just nobody cares. And so you have an area that is growing, it is doing well, but it just isn't getting, as I call it, it's just not getting the love. So overall, we like healthcare. It does well on down days as you see some rotation towards defensive. So we think it provides a lot of ballast relative to the two names that are here on the bottom contributor side. So Zoetis is very similar to what Richard was just talking about with Chewy. In the pet dynamic space, you've got consumers are feeling pinched. They've been going to their vets fewer. There's also a little bit more competition for some of Zoetis's products. The dynamic that's different between Zoetis and Chewy is that with Chewy, there are many places you can get dog food or treats or things like that. With Zoetis, there's really only one, sometimes two, usually maybe max three companies that you can get medications from. So it is a much smaller area, a lot more difficult to do substitution. So we still like Zoetis for the long run. Excuse me. We do think that things have been a little bit challenged. The quarter was not great. We think that ultimately valuation is not demanding down at the current level. So we continue to like the name. With Insulet makes the Omnipod automated insulin device. You've probably seen it. It's a little white box that people often wear on the back of their arm. This is basically allows them to forego 3 to 5 injections per day and just have it automatically distributed via the little box. And so it has been a fast growing company, still one of the fastest growing in the medical device sector. But what's happened is sort of two factors that hit them in the really so far this year in the first and second quarters. One was a recall. All medical device companies tend to have recalls at some point in their lifespan. You don't like to see them, negative headlines, but the financial impact is pretty limited. So we're not too worried about that side of things. The other aspect is growth has been so good here in the beginning part of the year that even though management took up their guidance for the full year, it does suggest some slowing in the back half of the year and potentially dipping, excuse me, dipping below the 20% growth level. So investors freaked out about that a little bit, sold off the stock. But ultimately, like I said, at the end of the day, you've got a medical device growing at one of the fastest rates in the entire industry, and valuation has come down. We still like the name, we still like the technology, and think the competitive aspect is very favorable for them. Shifting gears a little bit to the financial space, you've seen a lot of concerns, which I touched on earlier, private credit. Do these start to cycle through into the major banks which lend them money, or cycle through to insurance companies which are often heavily invested in private credit? So those are concerns that I would say contributed to the underperformance of the financials in the second quarter. We're getting the earnings reports kick in here tomorrow. We'll see a lot of big banks this week. Should be a good sign of things to come. We think things will be strong. Equity trading, things like that have been really strong. Investment banking picking up again. They'll probably gloss over the private credit issues, but those are still concerns for us there. But overall, financials kind of just not a heck of a lot going on to be able to attract enough investor interest away from the AI and technology space. And with that, I'll hand it back over to you, Michael.
Perfect, Chris. Thanks. I think next thing we want to cover is some of the recent purchases and even sales of some securities that we own and got rid of. We'll start with ARM. Andy, I know you touched on ARM briefly. If you could go into a little bit more of the reasoning why we decided to purchase this company.
Sure. So as I talked about earlier, so ARM is essentially the CPU. They designed the CPU architecture that's in virtually every smartphone and increasingly now data centers. So they get, a royalty on, roughly 280 billion phones that are out there. And what really drove the stock, though, the past quarter was, as I mentioned, they announced this new CPU, which is really designed and purpose built for AI inference, which is a fancy way of saying like doing the actual work that you want AI to do. And they signed some new deals, some new partnerships with some companies as some kind of early testers of and they said demand for those new CPUs have doubled since when they first announced it at one of their, I believe it was an investor day or some kind of ARM Everywhere event that they host every year. And that is opening up a brand new, I think it's been sized roughly $70 billion server CPU market, because every chip, as I mentioned, that NVIDIA sells requires a whole bunch of CPUs around it to do the actual work, whether it's moving things around from in and out of memory to the actual GPU, what they call orchestration. And there's more CPU demand per GPU. And so it's just a nice way to um, sort of take advantage of the growth of data centers, the growth of AI infrastructure, while the company still maintains that nice recurring royalty-based business. Um, uh, I'll talk about the other companies we added. So Corning, which I'm sure most of you heard of, and that's because the company is about 175 years old. And what was once just a kind of sleepy glass manufacturer, they've really transformed the business in recent years towards not just supplying fiber and cable for connectivity, but also now that their actual glass is being used as sort of these substrates, if you will, are being used, within the servers to connect, um, one server to another, not just, from one data center to another data center geographically split apart, but increasing like within the same rack and within the same server. So historically, a lot of that's been done with copper, but as these GPUs and these semiconductors get faster and more demanding, there is a case to be made that optical networking is much more efficient, especially across longer distances where copper can't really work as well. So we're seeing more and more build outs incorporate Corning glass, and because of that, the company is now becoming much more recurring through long term hyperscaler partnerships rather than just sort of one time sales. So they have multi-year agreements with companies like Meta, Nvidia, and Amazon to provide all of this way to connect their servers and semiconductors. And they recently launched this plan called what they call Springboard, which is sort of their new phase of kind of reinventing the old glass business that they used to have. And since then, sales have grown about 40%. Margins have increased dramatically. They've doubled earnings. So we think there's a long runway for this business. I think I have a few other names on here. Am I right? Purchases. Yeah. So SpaceX, probably widely talked about in public circles, but I'll touch on it briefly here. So they have three businesses. They have the recurring revenue Starlink satellite internet business, which could potentially someday disrupt global telecommunications, especially as they put more satellites into orbit, lower orbit levels, which would reduce latency, improve coverage. So we like that kind of core business. They have the launch business, which has many long-term agreements with governments, organizations like NASA, as well as private businesses who are putting satellites into orbit. And I believe they have over 80%, maybe 90% market share of putting things into orbit. Just walking down near my home in Southern California, I looked up in the sky and there was another SpaceX launch putting more satellites into orbit. So I think the goal there is for them to do things like that on a much more frequent basis, putting more things into orbit. There are these future plans, which we're not really putting a lot of value on today, things like data centers in orbit as well, to reduce some of the need for power and energy and cooling that terrestrial data centers require. Again, much of that is sort of like on the come, and we're not really, banking on a lot of that to sort of justify the investment here. We like the recurring nature of the current businesses that it has. It does have terrestrial compute, which is in huge shortage, what they call Colossus, which has signed long-term agreements with Anthropic and Google and other companies. So we think it fits what we do, and we like the sort of long-term potential, sort of like one-off things that they're doing that could become big businesses if they can execute. But those are things that would likely happen years down the road, if at all. I think there was one sell in the quarter in my space, which I'll touch on. Snowflake, which is a software company. As I mentioned in my intro to tech, software is has become under pressure, and Snowflake was one of the poster childs for that software derating, despite good fundamentals. So it wasn't really a call in the business per se, but more of a portfolio decision to reduce software exposure overall in favor of some high growth opportunities within the AI infrastructure trade, and making room for companies, like an ARM or Corning and other companies where we have, greater visibility, fewer AI related threats. And so we sold Snowflake in the quarter.
Thanks, Andy. And Andre, I know we have Axon here. Can you share a little bit more on what Axon does for those that don't know the company?
Yeah, absolutely. So in Q2, we added Axon. This is a public safety company that integrates devices such as body cameras and tasers, where they have a virtual monopoly, as well as the drones, counter drone technology, and the associated software, including evidence management and other productivity tools, which have a very compelling return on the investment for its customers. They package all of these hardware and software in a really highly recurring subscription model, and they charge on a per officer basis, with contracts ranging from 5 to 10 years, which gives management a very good visibility to future performance. The company is gaining traction in that private sector with major customers, including retailers such as Walmart, sports venue, including the World Cup stadiums, and most recently data centers as well. International expansion is also a growth lever for them. And lastly, public safety technologies focus on officers' accountability remain one of the few areas of broad partisan support, which is a really good position to be, and gives Axon that benefit of increasing government spending.
Thanks, Andre. And I know we got TJX. Rich, a lot of us are pretty familiar with the company. Can you share why we decided to buy it in the recent quarter?
Yeah, so TJX, the parent company of TJ Maxx, Marshalls, and Home Goods. This environment is excellent for off-price retail, with a consumer that is very focused on value. Um, TJX continues to take market share from department stores. Um, Basically, the environment for buying products from both brands and department stores is as good as it's ever been, where all three banners can go out and get product that's unsold. They don't care about fashion risk necessarily. They don't care about, what's in season or what's hip. They can then turn around and sell these products for up to a 30% discount. People love sort of the treasure hunt nature of these businesses, where they go in and they can find something that turns out to be a really incredible deal. Highly defensive, and very consistent in terms of unit growth, comparable sales growth, and a consistent compounder of earnings. So that was our replacement for Chewy, and a business that we think is going to do quite well here moving forward.
And Rich, can you share a little bit more of why we sold Chewy? I know we subbed it out kind of for TJX. What did you see with Chewy?
Yeah, I think we summed it up when we talked about their underperformance during the quarter. I mean, for them, their business is pet, selling pet stuff online. When overall pet is slowing, there's only so much market share that they can really take. And at the end of the day, pet is a little more discretionary than I think might have been appreciated initially. Stuff that isn't feeding the dog or cat on a day-to-day basis is just stuff that you don't necessarily need to buy. And we started seeing that in their results, as sort of the pet, cascade of the COVID era has sort of worked its way through. And it's just a business where if the category isn't going to grow, the growth opportunities for them are not really great. And viewed TJX as a more attractive business in this environment.
Great. And Chris, if you could kind of bring us back to high level of how we're positioned now. I know it's roughly pretty similar, but kind of fill us in.
Yeah, so if you see the sector weights here on the screen, we haven't changed. Russell did make some changes with the recent rebalance. And as a reminder, Russell will be rebalancing twice a year now, which is definitely an improvement, especially on the small side of things where things got a little crazy. But you can see here that tech is going to be the biggest differential. We do like tech, we just don't like it to the tune of 55%. That's in the Russell 1000 growth. Um, Com services for Russell did come up a good chunk as they increased their weight to Google. And then consumer staples came down quite a bit. So even though we've come down, consumer staples as well, our overweight position there is still pretty sizable. We don't own any energy today. And real estate utilities, we leave those more towards dividend strategies. And then lastly, wrap up with the portfolio look. Nice blend of names that folks know and are in the news with some other lesser known names. Certainly, if any of these pique your interest, feel free to reach out to us. But then just to wrap it up, we like the equity markets. We are somewhat cautious. We would say that, AI is definitely a game changer. We're big believers in the long run. We have some concerns about, some short-term gyrations, maybe things getting ahead of themselves in certain areas. But we are investing accordingly, being selective, looking for companies with some downside protection in addition to the normal growth that we're always looking for. And with that, I hand you back to Michael.
Great. Thanks so much, Chris, and everyone for sharing your insights. We all really value it. We'll definitely plan to be back next quarter with another update. Here on the screen, you can see our contact information. Feel free to send me an email or a phone call if you have any questions, and happy to connect you with our portfolio team or talk through anything at a high level.